In this video, I'm going to introduce you guys to my favorite strategy, which is called the unfilled 15-minute fair value gap model. This is a one-to-one risk-reward system, meaning that I risk the same amount as I'm willing to make. Some people might call me crazy, but I have that base hit mentality. I go for consistent base hits and build confidence in the easy money trades. The advantage of trading such a low risk-reward system is that it's mechanical. You can actually replicate those trades over the long run, and also the likelihood of you having a big loss streak is very, very slim. It also really helps with my psychology because I don't have too much decisions to make, and also I don't trade with discretion, which is other words for gambling. So now let me show you guys this exact strategy. Let's get right into it. This strategy is called the unfilled fair value gap model, and it has 3 steps. The step 1 is wait for a fair value gap to get created on either the 15-minute or the hourly chart. What is a fair value gap? In this case, we have a bullish fair value gap, which is when the first candle's up wick doesn't touch the third candle's down wick, okay, right here. And it is a 3 candle pattern, and it shows us that the buyers were so aggressive within the previous range that sellers did not have a fair exchange. So now this area right here, the fair value gap, becomes an area that has low volume transacted within it. Okay, and what does that mean? In other words, it means that this area will act as a magnet, and you will want to trade back towards that gap as soon as possible. The second step is I need to see the candle number 3 close back inside candle number 2. What does that mean? What is my first, second, third candle? Let me show you right now. A fair value gap is a 3 candle pattern, and it needs 3 candles to form. So this one would be the first, this one would be the second, and this one would be the third. So here, even if we created a fair value gap right below us and it should act as a magnet, we don't have any confirmation that is telling us that the sellers are stepping in. So if we want to trade back towards that gap, we need to see that candle number 3 close back inside the range of the high of the candle number 2. So instead of the candle looking like this and breaking above the second candle's high, I want to see us close back within the range and form a big upwick. Once I see this, and this is my third candle, I know that the likelihood of us actually opening up lower to fill that gap is way more than us actually filling the high of that candle. My prediction here is as soon as this candle will close, the third one, the fourth candle will open on the 15-minute chart, and we will drive back down to fill the entirety of that gap. Okay, so my prediction is I think a bearish candle is going to print within the next 15 minutes because of the candlestick formation and because of the fact that we have a gap below us that should act as a magnet and as an area with low volume. Now that we know that the fourth candle actually has a pretty big likelihood of printing bearish, we need to find an entry that is replicable, and I want that entry model to be mechanical and actually give me a story of the 1-minute chart. So we have multiple models that we can use. We actually have the inversion fair value gap or the change in a state of delivery. So what is an inversion fair value gap? The first entry model that I'm going to be looking for within that third candle is the inversion fair value gap. It is a 180 confirmation. What does that mean? It is when price pushes very aggressively on one side, creating a bullish fair value gap. And then when you create that bullish fair value gap, you're basically telling yourself that there's a lot of buyers located within that 1-minute chart, okay, where that fair value gap got created. So if you're truly bullish, you should respect that gap in order to create new highs. But if you're bearish though, and you actually have the magnet below you, which is the unfilled 15-minute gap, then you will disrespect that 1-minute structure, use it as support in order to trade back down towards the unfilled fair value gap. That would be the first entry model. The second one that you're looking for within that third candle is the change in a state of delivery. It's when you create a high, low, higher high, and then when you create that break of structure, basically you're telling yourself the same thing as the fair value gap creation. You're using this box and you're like, okay, there is a lot of potential buyers that will defend their positions right here in order to create a new high. Okay, if we're truly bullish, we should respect that order block, that bullish order block, in order to create new highs within the market. But what is actually going to happen here, since your target is to the downside and you believe that the market will go and fill that unfilled 15-minute gap, then what you'll be looking for is actually that order block to get disrespected and us changing the trend basically. So high, low, higher high, lower low, and once you have this, then you use this area right here that should have held if you were truly bullish as an area of support in order to trade back down towards the unfilled fair value gap. So here we're just looking for confirmations of displacement showing us that the sellers are stepping in, and also confirmations of breaks of structures to the downside. That's basically showing us that the area of low volume below us is actually attracting price. Now let's do the opposite scenario where we actually form a bearish fair value gap. Step one of this model is we want to wait for a fair value gap to get created on either the 15-minute or the hourly chart. What is a bearish fair value gap? It is a 3-candle pattern where the down wick of the first candle doesn't touch the up wick of the third. What does that tell us? It tells us that sellers were way too aggressive within the previous range, that buyers did not get a fair exchange. So in terms of volume, this area right here on the chart is an area with low volume. And for the market to be efficient, we need to retrace back towards that fair value gap in order to find fair value. So when we create a gap, it tells us that the market is currently inefficient, and this is an inefficiency, and for it to gain the fair value again, then we need to trade back towards it and actually feel that imbalance. We formed the fair value gap so we can check the first step. The second step is we need the candle number 3 to close back inside candle number 2. A fair value gap, as I said, is a 3-candle pattern, and this one would be the first, second, and third. So here the problem is we formed the gap above us, but this third candle is not showing us any signs that the buyers are stepping in. So now I would want to see this third candle actually closing back within the range of candle number 2 to tell me that the responsive buyers stepped in, and we actually have more chances of filling the gap than the low of that current candle. So instead of this candle looking like this, I would want it to look like this right here and have a pretty large down wick. And then once that third candle closes, I am expecting the fourth one to actually print to the upside and get attracted by the area of low volume, which is the unfilled 15-minute fair value gap. Within this price action, I'm actually anticipating the next 15-minute bar to print bullish and not bearish because of the gap above us. So here is the fourth candle, and I'm looking to see a potential long opportunity from that third candle closing and the fourth one opening. So when you create a bearish fair value gap, you are looking for longs to trade back into it. So what are my entry models for that? I am looking to see if we have an inversion fair value gap or a change in the state of delivery. So an inversion fair value gap is a 180 play, basically where you have a lot of aggressive selling within that third candle, and then you create a bearish fair value gap. That fair value gap here will tell you that the sellers are being very aggressive. And if you are truly bearish, you should hold this level in order to create new lows. But now you have a gap above you. And what is most likely going to happen is that you'll see this gap being disrespected. And once this gap is being disrespected, you know that the sellers got squeezed within this range. So you are going to use them as a cover and as a way to find support in order to trade back towards that unfilled fair value gap, which should act as a magnet. Last entry model that we're going to see is the change in the state of delivery. So what is that? It's when the third candle creates a low, high, lower low, and then you have this little box here, which I call an order block. When you see this, you know a lot of sellers just basically took over those buyers and broke structure to the downside. So if the market is truly bearish, we should respect that bearish order block to create new lows. But what is going to happen if you have an unfilled gap above you that should act as a magnet, you will most likely disrespect this bearish order block, which will turn into a change in the state of delivery, so a change in the market direction, and you're going to use this little box here, that failed order block, which changes into a breaker block, as an area of support in order to trade back towards that unfilled fair value gap. But you can see here that framework wouldn't work, that entry model wouldn't work if the 15-minute chart did not have the perfect alignment. Fair value gap above you, third candle closed back inside the range of candle 2, and looking to see if that third candle actually has the perfect structure in order to predict that the fourth candle is actually going to open up higher instead of lower. Now that you understand the model, let's go over 5 trades you could have caught last week using the unfilled fair value gap strategy. And here I'm going to be using this indicator called ICT HDF candles by Foddy. So that will show us the last 6 15-minute candles within the range, instead of just swiping from the 1 to 15 then 5. You know, it's so much easier to have those candles in order to know if you have a gap above or below you, and then trade either a little bit prematurely before that third candle closes, or as soon as that fourth candle prints, and predicting that price is going to go back towards that gap. So this is a very good indicator that I use. Let's see if there is a trade within this range. So this 15-minute candle closes and a brand new one opens. So now I know that if I don't trade back towards 529, which is that first candle's down wick, then I'm gonna have a gap above me. Okay, so let's see what is happening right there, right here. Okay, right here we have a very good confirmation. We have a big displacement to the downside from this candle, and I look at two things. I look at structure, but I also look at timing, because I need to know when is my 15-minute candle actually going to close, because if it's going to close in 1-2 minutes, then I could potentially enter a little bit prematurely, predicting that the rule number 2, which is candle 3 closing back inside candle number 2, will actually happen because of the structure of the 1-minute chart. So now the first confirmation is within that range is we have an unfilled fair value gap right above us. Okay, this is step number 1. So we can check that we have the unfilled fair value gap above us. What does that mean? Sellers are way too aggressive within this range, that buyers did not have a fair exchange. So in terms of volume, this area right here has extremely low volume, and it means that price is currently inefficient, and for the market to be efficient, we need to retrace back towards that gap as soon as possible to find fair value. Okay, so now I am gonna see this candle close in 1 minute. What did we form on the 1-minute chart? We have a sweep of liquidity right here. Okay, and then we actually have what we call an inversion fair value gap. Okay, there was 2 fair value gaps within this range, okay, on the 1-minute chart, and then we had basically an aggressive buyer stepping in and making us close above those 2 gaps. What I'm seeing on the chart here is when you create a bearish gap, if you're truly bearish, you should respect that gap in order to create new lows. But here you're disrespecting it, plus you have your magnet level above you. So now it becomes a very good trade to potentially take to the upside. So now I have my inversion gap right above me. Right here just formed within this range. I have my unfilled gap above me, and I have a good sweep of sell side liquidity. Okay, I'm gonna mark this out right here. So now what am I gonna do? I am gonna take a long position right here, and I'm gonna put my stop loss right below this candle's low, take profit back for a 1-to-1 risk to reward within that unfilled fair value gap. This is what I'm gonna do right here. I expect that as soon as candle number 3 will close, candle number 4 will print to the upside to fill the gap. Okay, so here, let's see how that goes. I'm gonna put it right there. Closes, and within 2 minutes you hit the target. Let's take a look at scenario number 2. We have a very aggressive downtrend. You can see here the last 6 15-minute bars were very aggressive to the downside, and that tells me that we need a healthy retracement. We need to see a pullback at a certain point if candle number 3 closes back inside candle number 2. Okay, so here let's see what happens. So we're sweeping the previous candle's low, and we're currently closing back within the range. Okay, 2 things that I look at when I see this. I look at timing, and I also look at price. So here I have all the confirmation that is telling me that price is going to be attracted to the upside. Why? We have an unfilled 15-minute gap above us, which is the first check, first step here. Then I see that the candle number 3 closes back within candle number 2. Okay, so now I know that responsive buyers stepped in, and now I can actually look at the 1-minute chart to find an entry. So then what is my entry right now? I have a low, high, lower low, higher high. What is that? It is a change in the state of delivery. So when I see this, I know I can potentially enter on the neckline right here on the pullback, because this is an area that sellers should have stepped in to defend their positions, but actually got squeezed and buyers took over. You can see here within that 1-minute bar, they try to step in and then buyers took over. So here, what am I going to do? I am going to look for a potential long opportunity if I get the chance to see a pullback within that range. So I'm going to buy here, stop loss just right below this candle's low, take profit at a 1-to-1 risk to reward back within this gap. This candle is going to close in the next minute. Okay, let's see how that goes. Okay, so we're in longs. Perfect. So we can see within 6 minutes, we hit the target. We opened up lower, filling those orders within the change in the state of delivery, and then we went back towards the gap because this is my next fuel level. We need to trace back towards that gap, even if we're bullish or bearish, because even if we're bearish, we need fuel for us to go back down. Price will never just rocket to the downside without ever pulling back. When you create those gaps is usually when you see those pullbacks to then continue that downtrend. Quick one here. If you're looking for a prop firm to trade with, then you need one that you can actually trust. I personally use Tradeify because they're by far the best prop firm in the game. If you want to support your boy, make sure to use code AMAS at checkout for the highest discounts. Let's keep going. Let's see the third scenario right here. We have a big bullish aggressive candle that is telling us that the buyers are currently being very aggressive. So this is the first candle, this is the second, this is the third. So if that third candle prints and goes to the upside first, creates an upwick, then closes back within the range of candle number 2, and we never traded back towards the first candle's upwick, then we will have a bullish unfilled 15-minute fair value gap right below us. That will tell us that the buyers were way too aggressive and we need to find fair value to the downside. And then my 1-minute chart will give me the confirmations if I should enter or not. So let's see how that goes. We pushed up very aggressively and then we started to break structure. Like I said, I look at time and I look at price. Even if right now we created that inversion fair value gap, and even if we created that breaker block, so that change in the state of delivery, it is too early for me to enter. Why? Because there is 8 minutes left for that 15-minute bar to close, and things could look very different within the next 8 minutes. So I need to wait and be certain that we're going to close back within the range of candle number 2. Okay, when am I going to be certain? When there's 1, 2, 3, maybe 4 minutes left for that 15-minute bar to close, then I'm going to be certain, depending on the structure, if I should enter or not. So let's wait. You can see right here we're pulling back and it's 57. There's 3 minutes left for that 15-minute bar to close. If I get a small reaction from that level, I will know that I am most likely going to create bearish structure from that bounce rather than bullish. So here, what do I have? I have a bullish unfilled 15-minute gap right below me. Okay, that tells me that buyers were way too aggressive within the previous range, that sellers did not have a fair exchange. So here, this area right there is an area with low volume. So for the market to be efficient, we need to retrace back towards that inefficiency as soon as possible. So the bias is shorts until we fill this gap. When this third candle will close, a fourth one will open, and I will basically predict that the fourth one will dig into this gap. Okay, so here there is 1 minute left for that 15-minute candle to close. So now I'm going to enter shorts, stop loss right above this candle's high, take profit at a 1-to-1 risk reward back within this gap. Okay, why? There's only 1 minute left. We created what? We created a sweep of liquidity right here. We can see it. We also created, so I'm going to mark everything out. We created a buy side liquidity sweep. Where's my buy side? Okay, buy side liquidity sweep right there, which is exactly this 15-minute bar's high getting swept by the third candle. Then we actually created an inversion for value gap right here. Mark this out, IFBG. Okay, and we actually also created a change in a state of delivery. What is that? High, low, higher high, lower low. And then you use this box right here as an area of sale opportunities to trade back towards the unfilled. Okay, so here I'm in shorts just for a small little 1-to-1. It is a scalp model and I want to be right more than I'm wrong, and I actually want to have consistency within the market instead of going for home runs. I want to build confidence with a certain model instead of just swinging for the fences. So here, small little 1-to-1. Let's see how that goes. And within 4 minutes, you hit the target. Let's go over this scenario right here. We can see we have a big bearish aggressive candle that is forming within the 15-minute chart. We are at 8:30. It's a little bit different, but the framework remains the same. The market mechanics behind why we should look for longs remains the same. So here we can see we have a big displacement candle. This is the first, this is the second, and this is the third. If this third candle right here closes back within the range of candle number 2, plus we never traded back towards 886, which is the first candle's down wick, we will have an unfilled gap right above us. If we have the right structure within candle number 3, we will long back towards that inefficiency and predict that we're going to see higher prices instead of lower prices at a specific timing. So here we went back down very aggressively to the downside. Am I trying to predict? Am I trying to long right now? No, I need to wait for confirmation that is proving me that the candle number 3 will close back within the range. Timing and price. So here, waiting, and then right there we have a pretty good confirmation. We have a big displacement candle. We're sweeping liquidity right here. Okay, we're sweeping sell side. We have also, so basically right now we have an unfilled 15-minute gap above us. We'll mark this out right here. M15 UFVG, as you can see, which will act as my magnet. Then right now, candle 3 is closing back inside the range of candle number 2. What's the timing though? It's 8:41, meaning that there's 4 minutes left for that 15-minute bar to close. Did we form good enough structure for me to predict that the structure will hold and not actually get disrespected, so the candle 3 would fail the framework basically? So here we have an inversion fair value gap being formed from those two candles. We're going to mark this one out because this was the last fair value gap within the range. So now we have all the confirmations in the world that is telling us to go along. Unfilled gap, candle 3 goes back inside candle 2, inversion gap right here on the 1-minute chart, sell side liquidity sweep. We have a very good model right now. So now I'm going to anticipate that we are going to bounce from this inversion gap because there's only 4 minutes left for that 15-minute bar to close. Going to put my stop loss right here and take profit back within the gap. If for some reason this candle right here, this inversion gap doesn't hold and we start pushing down right below 716, which is the low of that 15, I will take a small loss. Okay, that is the prediction play, but works in a lot of good scenarios, and sometimes is basically the only scenario that you will be able to take depending on some market conditions. Sometimes it is going to be way harder to find trades if you're not predicting. So let's see how that one goes. So you get filled right here, and then you immediately bounce from the last candle. It's 8:44, meaning that this 15-minute bar is going to close back within the range. We are very confident, so that's good. Then the next few bar opens and we opened up higher back within this gap. Is that random that as soon as this bar closes and we have a gap above us, we are pushing towards that gap? I wouldn't say so. Okay, especially with the number of trades that you can find that are exactly the same framework, same exact timing, same exact structure. There's definitely edge to be found there, especially if you're trading prop firms with that low risk to reward and high risk system. If you have a good business plan and you know what you're doing, you're gonna smash it. Now let's take a look at the last scenario right here. This 15-minute bar is gonna close right now. We can see this is a big bearish displacement. Candle number 1, candle number 2, candle number 3 is going to print right now. It's printing, it's going down. Now I know, again, I need to see my model before it actually happens. This is what makes a good trader. And here, multiple things. For me to have a gap above me, I need to never trade back towards 429, which is the first candle's down wick. If we create a bearish 15-minute gap above me, I also need to wait to see how that third candle that creates the gap closes. I need to see it close back within the range of candle number 2. If it doesn't do that, responsive buyers did not step in and sellers are still in control, so I wouldn't expect that gap to get filled at all. Okay, I'm waiting. Then once we have that bearish gap above us, I know this area will have low volume and it will be attracted to price. Okay, price will be attracted to that gap, and it is most likely going to be the next bus stop. Okay, so now we're chilling. I'm actually also going to look at cues of time. So we are chopping back within this range, but we are pretty far from that second candle's low. Okay, so now there is 4 minutes left for that 15-minute bar to close. We are pretty far from that second candle's low. We know that currently we are most likely going to see a buy model. Okay, so now let's just wait for some more displacement. Perfect. 58. What does that mean? 58 means that there's only 1 minute left for that 15-minute bar to close. And what do we have? We have an unfilled 15-minute gap right above me, right there. I'll mark this out. 15-minute UFVG for unfilled fair value gap. Then, so this is step number 1. Step number 2, we have candle 3 closing back within the range of candle number 2. Then we actually have my change in the state of delivery. High, so we're going to start with the low. Low, high, lower low, higher high. Right there, this neckline right here will most likely get used as a bounce level to see some upside. Okay, so now what am I going to do? I'm going to do exactly this. I'm going to wait for price to bounce from that change in state of delivery, predicting that sellers that got squeezed here will most likely just cover their positions and buyers will defend it. Okay, to see some upside back towards that inefficiency. So then I put my take profit right here. Stop loss where? At a 1-to-1 risk to reward. Do I need more? No. Even if it could run way higher, I just need consistency, and I need to build a plan that I can replicate every single day, knowing that I have edge. Okay, I need it to be mechanical, and I actually need to be able to justify the reason why someone who's going against me would lose over the long run. It's extremely important. So now, see the pullback right here. Perfect. This candle is closing right now. Let's see what will happen. Brand new one opens, smashes the TP, immediately backed into the gap. Is that random? For me, one thing that tells me that the model is not random is the timing before, basically the timing of the entry and the exit. So how much time do we actually spend in the trade? For me, a good scalper is someone who wants to be right quick, someone who wants to be wrong quick. And here, it actually gives us this exact framework. When we enter, we usually smash take profit within the next 5 minutes, which is usually what you want to see if you're predicting a 15-minute bar. If you enjoyed this video, make sure to like and subscribe to the channel. Again, I appreciate you guys so much for the love and the support. I love you guys, and I see you guys on the next one. Peace out.